Hello, welcome to Property Nomads. Plenty of news to go through with you today, and it is a return of Marc of Wharf Financial. Apologies, it's been a long time, Marc, since you've been on the show, but how are you doing?
Yeah, good, thanks. It's there's been a lot going on, so hopefully we've got a lot to talk about today.
Yeah, 100%. We were just chatting off air briefly about how we were with or how we're getting on with our targets for this year, and I think we said between us we're pretty much on track. Whether that's a good thing or bad thing, given what we predicted, I don't know, but we'll find out. Marc, plenty going on. I don't really know where to start. I mean, the time this goes out, we're a few days away from the next Bank of England meeting. Chances are they're going to hike again, either to 4.75 or 5%. I guess I'll start with my usual question. How have you found the market, being a broker? What's going on? Inform us, please enlighten us.
So we're predominantly property finance brokers. Probably 75% of what we do is property finance, but there's 25% which is trading business, which gives a different perspective on the market slightly. So with the property stuff, we are quieter than we have been, and there's less inquiries coming through. And the inquiries that are coming through are more, do you think we'll be able to get enough funding to be able to do this if we put in a sneaky offer of, below market value? And usually it turns out that the day one value that the lenders can offer is not enough for the developers to make a profit. So yeah, the inquiry levels have gone down and the quality of inquiry has gone down as well. So there's less and less we're seeing, and the reason for that, in my opinion, is rates have gone up, obviously, so it erodes the profit and makes it harder to work. Also, when they're exiting onto a longer term deal, it's harder to do so because of higher rates. But also the actual availability of stock out there isn't where it should be in this type of market. The values haven't dropped enough for people to be able to pick up these bargains, and that's the disparity we've got. So when the property prices or land prices do start to dip, it's going to make it more a development more achievable. So hopefully that'll correct itself slightly. But then, as we were talking off air, my prediction was for house prices to stay stable this year. So I'm going to have to be wrong in my, I suppose, long-term view to be able to hopefully get the business flowing again at the levels it was. So yeah, that's the property side. And then on the other side, on our trading business side, we're seeing lots of inquiries, and that is because of the need for cash flow. Where businesses are being squeezed, they need more cash flow, and that's the area we're helping with: import, export, and also the invoice discounting factoring side as well.
It might be slightly off topic. You go a little bit more into that, just in case there's probably people listening that are thinking, I might need a bit more cash flow. Marc might be able to help go into that a bit more if you can.
Okay. So you've got the trade cycle for any business where they, for instance, it's easier to talk about a manufacturing business where they would buy products from, I don't know, China, a big warehouse in China, a factory in China. Then in the end, they would end up selling that to a retailer in the UK. So there are gaps in that trading cycle where money is needed, because invariably a Chinese factory would want money up front or a certain percentage of money up front for creating the product, and then it takes time for that to be delivered. We've just talked about a company that takes 120 days from order to the actual product arriving in the UK. So it's a long time, and the customer has to fund that. Then you've got the other side where you're dealing with the likes of Tesco, B&Q, whoever, and they will want the goods delivered to them, but they won't pay you for another, say, 60 days from delivery. So you've got a a time frame of 120 days plus 60 days where you're actually not getting any money in, but you're shelling out all that, stock and labor and everything like that, delivery, warehouses, wherever it may be. So that gap needs to be funded. And that's where we come in to look at that gap, and we find a lender who can plug that gap with a finance facility and make the cash flow easier. And then what they can do is, if the cash flow is easier, they can buy more stock and therefore they can sell more. It just helps the business expand.
Fair enough. We've always sent people to you for property stuff. We'll just start sending people to you for any other. Well, it's always useful to chat to brokers no matter what's going on. So I urge people to listen to this, even if it's not property and it's trading. As Mark said, please do contact Mark. His details will be in the show notes. Going back to property then, interest rates are causing a lot of people a lot of concern at the moment, whether it's developers, landlords, first-time buyers. From developers and landlords that you speak to, are a lot of them put off by the interest rates at the moment, or is it just a case of, do they think, oh, it's just bad timing, or it is what it is, I'm just going to crack on and deal with it? What's been your feedback from chatting to your clients?
They are put off by the interest rates, and they can't achieve the same amounts of lending. So usually a lender will use a stress test to be able to work out how much they can lend to a particular customer. And because the stress tests have become more harsh, they are not able to get the LTV that they want to get. So as rates have risen, it's harder to achieve the top LTVs, and therefore they've got to put more money into the deal. So they either have to wait, or they have to get more investor finance, or whatever it may be. And it slows things down, makes it more harder, makes it more risky. And yeah, people just don't want to do it. So you've got that problem. You've got material costs that went up, and you've got values, like I was saying earlier, of the land that haven't gone up. So therefore, your total cost base has gone up more than ever. And then lenders are still wanting the same profit on cost percentages, and it makes it very difficult to achieve the goal that you want to achieve. And it makes it difficult for a lender to say, do you know what, that is a good project, we will back it, because the percentages aren't there.
And I guess this is something, when I think out loud, this is something that's going to be sort of a theme, I imagine, moving forward, because we've already started to see slight corrections in the market itself. We are, well, as we said at the start, there'll probably more than likely be another base rate increase this week. I imagine there'll probably be another one at some point, and they'll keep going until they break something. And the thing with increasing the rates is the knock-on effects normally not felt for 12 to 18 months down the line.
My question has taken over your host job now. What is the reason? What is the reason for them increasing rates, in your opinion?
That's a very good question. I'll try not to waffle on for about 6 hours with an answer. So I think it's people trying to follow modern monetary theory and going, if we increase interest rates enough, we will be able to tame inflation. And I use that term loosely because the damage has been done severely in the last 3 or 4 years through a number of circumstances. But history shows time and time again that if you keep raising, even ever so slowly, there's never an immediate effect. So Bank of England can go out and raise rates to 8% this week, and there won't be a massive, the effects of that won't really be felt through the markets for the next 12 to 18 months. These things take time to go through. So in order to tame inflation is my answer to your question. But I think that's just what they're saying, because that's the only tool they've got in their toolbox at the moment.
It is, and I totally agree with you. I think what the issue is not inflation. Is not being caused by the economy or the lack of money, or the too much money in the system at the moment, whichever way you want to look at it. What is causing it is supply chain. Where we had COVID, where we have the war in Ukraine, all those sorts of things are causing massive supply chain issues. And that is the reason for inflation. And it's nothing to do with, there's too much money in the system or anything like that. Because as we've just spoken about, it's harder to get things done. So it's the actual rate rises are making things more difficult, but you've still got the same problems with inflation. And it's because of the supply chain. And that's not going to change.
No. And to be fair, the episode, was it before or after this? Maybe Thursday's episode as well. That I go into that even more so, saying about that, because once you've done the damage on the supply side, it's not something that can be fixed very quickly. It's something that could be fixed very easily, but because of votes and energy policy, I mean, to be honest, it doesn't matter anyway. We're going to have a Labour government and a massive arse majority in 2024. Personal opinion. Do I want to see that? No, not particularly, but I think that's going to happen. So it's very easy to fix the supply in some instances. Whether they'll do it, because it's not voter friendly, is a different story. But when it comes down to either importing goods, like you say, for material, you're doing a big project, you need loads of timber and steel or whatever it might be, because of tariffs and shipping costs and all that sort of stuff. Yeah, that to fix that can take a long time. So the cycle, we're in this vicious cycle. We said this, you and I said this 12 to 18 months ago, that we could see that we're going to be in a vicious cycle. And it's going to take, I'll say it when I say it again, it's going to take one nasty ass recession, and it should do, to reset, and then we'll just go again. We'll have a nice old bull market, and then we'll get, same cycle happens again. But no, totally agree with you on that, and not enough people look at the supply side of things. So I'm glad you've brought that up.
Yeah, and the Keynes theory, and I've spoken about this on your podcast before. The Keynes theory says you have peaks and troughs, and there's a 12 to 16 year window where it all goes well and then it resets. And the last time it all kicked off properly was 2008. So where are we? 2023, 16 years, 2024. We're due it. It needs to happen. It's happened all the way through history. It just, people forget. And going off on a slight tangent, one of the issues is social media. And social media now creates more crises, that's the word, more crises than there was previously, because people didn't know as much news. And things like we see in the news today have a massive ripple effect, and that wouldn't have happened before. You didn't see that, and this creates a slightly different way of looking at economics, because it can erode confidence quicker, and the general public can see what's going on. And because confidence gets eroded quicker, I think we're going to see more smaller blips along the way. So it's not going to be maybe as big a peak and trough as we saw before, but there's going to be a lot more, jolty movements if you were looking at it on a graph. So I think how society is changing has an effect on it as well. So
yeah, it's an interesting point. So it reminds me of these bank runs a little while ago, Silicon Valley Bank, all US stuff. And I say all US stuff because the same thing could easily happen here, because of the exact thing you've just said, that all it takes is, a viral video on TikTok, Twitter, insert social media platform here, and that creates panic. But also with not just social media, but I don't know who brought this up, but they made a good point that you see all these things from like, we remember the things from Northern Rock 2007, 2008, people queuing up and down the high street to withdraw their cash. Of course, got online banking. So click of a click of an app or two, or playing around with an app, you can transfer that cash to somewhere more secure, a lot quicker as well. So banking apps are going to exacerbate the situation. But yeah, that's an interesting point about social media. A few people have said that.
But I think
we'll see what happens.
where we're slightly different, though, where we are at the moment, if you look at Silicon Valley that you mentioned, and Signature, and it was a Swiss, Credit Suisse as well, the reason they went under was not because there was a problem in the banking community, it was because they were poorly managed and they were individual cases. The implementation of Basel III, which happened between 2010 and 2020, that made sure banks were more well capitalised, so that they had their risk-weighted assets percentages in line with where they should be. And what I mean by that is they have to hold back a certain amount of money to be able to lend money, and they had to hold more back as part of Basel III than previous forms of the guidelines. So the banks are more well capitalised now, so they're more stable. It's harder for them to rock. And the other good thing is, well, it's a good thing and a bad thing, the banks are more profitable now. So if you look at all the banks, even though everybody's been saying how, Lloyds aren't lending, or, they're not doing anything, they are still very profitable. RBS are still very profitable. And they're in such a better shape than they were. And also, if you look at things, the challenger banks, they have to hold back more capital than the high street banks because of the nature of their business. But the people who put these regulations in place have done so to make sure that in environments like this, the system is more stable. So I think we're not going to get a rerun of 2008. It's going to be a more stable environment we're in, and the economy will sort itself out, but it will cause a potential recession going forward. And obviously, when there is a recession, there's opportunities for people, and that's when people can make a lot of money. So it'll be interesting to see.
Yeah, I'd say I'm a bit more doom and gloom than that. I would say that, I don't know, let's just see what happens. But what I will say on that, just to counter myself, because I like being hypocritical at some point, is yes, it's a very good point about opportunity. We've always said the same thing, that as doom and gloom as we can be, or as realistic as we can be, both you and I as individuals, when we do these podcasts, that at the end of the day, there's going to be opportunity. And this is a time where, if you are, sometimes it's good to do nothing. It really is. It's best to sit on your hands. But this is also a time where it's good to be out networking. It's good to be talking to people. It's good to be speaking to, your broker like yourself. It's good to be talking to, high net worth individuals, because when things do go pretty peaked on, then, as you quite rightly said, that's when, I can buy all of this land, or I can buy all these buildings, or I can convert this. I think we're going to see that in commercial property moving forward, as if it's, to be honest. But yeah,
let's hope that the planning authorities keep up and they make life easier for people.
That's probably a different podcast in itself, Mark. That's again, good point, well made. Yeah, I'd love things to work in better unison sometimes, but no, there's always opportunity. And yeah, I think of all things, we could go into various rabbit holes. It's probably best not to. I think let's keep it there. I think when we come back next time, Bank of England would have increased its base rate to either 4.75 or 5 if they decide to stick. I'll be very surprised. And I guess we'll go from there.
Good.
Fantastic stuff. As usual, links to contact yourself, to get in touch with the team at Wharf Financial. Those links are in the show notes, or if you're watching this on YouTube, just in that box below. And Mark, thank you very much for your time, and we'll catch up again soon.
Thanks a lot.